Hi, I'm Danny LeBeau, and welcome back to the Fourth Revolution, where I discuss stocks for your portfolio of the future. The markets are acting like this is the Armageddon of equities, and have pulled down all the major indices by almost 20% in the last few weeks. Oil prices plummeted by 25% on Monday, following the commencement of an oil price war, which the Saudis incited in retaliation of Russia not cooperating with OPEC's production cut plan. All the U.S. indices tumbled over 7% on Monday in response to this unprecedented drop in oil prices, the worst one-day drop-off since the heart of the 2008 financial crisis. U.S. benchmark interest rates, the 10-year Treasury yield, fell below 0.5% temporarily on Monday, and the markets are now pricing in a Fed funds cut of 75 basis points in FOMC's meeting next week. This is following an unprecedented emergency 50 basis point cut March 3rd by Jerome Powell and his dovish band of governors. If the Federal Reserve were to cut rates by 75 points, they would have only 25 points of ammunition left to fight any further economic issues. And this is implying that the Federal Reserve thinks that the coronavirus is likely to cause an economic downturn. We are on the edge of a bear market. But is it warranted? This market is very reminiscent of the 2008 market crash on the surface level. But if you look a little bit deeper, these two issues could not be more different. So here's a chart of both the 2008 drop-off and this most recent crisis crash from the coronavirus. So on the left, you can see that it was a slow decline from the end of 2007 into 2008, and the real sell-offs only began when the banks lost liquidity, which was in the third quarter into the fourth quarter of 2008 when we saw the huge drop-offs. These were gap downs. The markets were very illiquid. There wasn't very many people trying to buy anything. And this is not the same as what we're seeing today. We're just off of our all-time highs from all of our major indices, and we've dropped almost 20%, but it's been a very, very rapid drop-off of just about 3 weeks. So there's a ton of differences. And right now, the impact of the coronavirus is merely causing a short-term earnings recession due to the disruption in supply chains and hampered global demand. Balance sheets, on the other hand, remain healthy and quite liquid. This is very different from the 2008 crisis, where the backbone of the U.S. financial system, the banks, had toxic balance sheets and couldn't provide proper liquidity. Employment figures just came out last Friday illustrating robust job growth and unemployment remaining at its half-century low. The extraordinarily dovish behavior by the Fed is building a springboard for our equity market to fly off of once this bottom is found. There's no doubt in my mind that a V-shaped rapid recovery is on the horizon, but when and at what level is still elusive to me and many traders. I'm waiting for Trump and his administration to start taking this virus a little bit more seriously and begin providing some fiscal stimulus. Once this happens, I think we're going to see a bottom very soon after. And if you're a long-term investor with a time horizon of a year or longer, I would not hesitate to begin buying your favorite equities at a discounted price. Stocks that I'm looking at and keeping an eye on include Disney, Lockheed Martin, Alibaba, Microsoft, and Adobe. These firms have strong balance sheets to weather the short-term storm and robust long-term potential. In the words of history's most successful investor, Warren Buffett, we should be fearful when others are greedy, and greedy only when others are fearful. So thank you for watching The Fourth Revolution, and I look forward to speaking to you guys next time.